So good afternoon. So in the previous classes we discussed regarding unit number 1 as well as unit number 2. So today we'll begin with the unit number 3, that is foreign exchange risk management. So in the previous chapter, that is foreign exchange market, we studied what is foreign exchange market, how does it work, and what are the transactions will happen in foreign exchange market. So coming to this chapter, what is foreign exchange market? The foreign exchange market is nothing but the place where one country currency is exchanged with the another country currencies. As I said, I can say with an example. Take for example, if you borrow something from USA means, if you want to import something from USA means, or take for example, if you want to buy iPhones from USA, and we need to pay as per the USA denomination. We can't pay as per the rupee, we need to pay as per the USA denomination. Then we are going to make an exchange of Indian currency with the US dollar. Then we are going to make a payment for the the exporter. Like that we used to do in foreign exchange market. So as I said, the foreign exchange market will have certain risk. So this chapter is nothing but how you are going to manage your foreign exchange market risk. So you know the meaning of foreign exchange market. Here the risk is nothing but the fear of loss, or the currency fluctuation, or any other factors that going to affect the reduction or the increase, appreciation or depreciation of the value of the currency. That is nothing but a risk. If any kind of fluctuation happens in a market in the international level, like cross-border transaction, then obviously either we have to pay more or pay less. If you want to pay more means it is a loss for us. If you want to pay less means it is a loss for the other country, like other counterparty, I can say. So first, if you want to start, so what is foreign exchange risk? So the foreign exchange risk is nothing but the risk of loss that can arise in international financial transaction, like nothing but currency fluctuation. As I said in the before example, like if you want to buy, take for example, like 100 iPhones from USA, and we need to pay rupees 10 lakh in total. We are buying 100 iPhones and we are paying 10 lakh rupees, the total cost of 100 iPhones. Then suddenly the currency fluctuates and the US dollar will increase against Indian currency. Then what will happen? Instead of paying 10,000, we will pay 12 lakh. Instead of paying 10 lakh, we will pay 12 lakh. That 2 lakh is nothing but the risk, the fear of loss, the currency fluctuation. So this is a loss for us, for an Indian company. It may be a benefit for US, but it is not the benefit for us. So to manage this, the difference of 2 lakh, we are using foreign exchange risk management. So to manage the risk management, we have the hedging strategies. Hedging is nothing but defending the 2 lakh, defending the loss, defending the currency fluctuation, avoiding the losses or currency fluctuation. That is hedging. Hedging is nothing but it is a strategy used to reduce the risk or reduce the currency fluctuation. Then why you want to reduce the currency fluctuation? Because to minimize the loss or to reduce the loss. That is the main aim of hedging against foreign exchange market. So next concept, in a hedging strategies, I already discussed in the unit number 2. There are certain various hedging strategies. Take for example, first one is spot market, forward market is there, as well as option is there, and swap. So these are the various hedging strategies we are going to use in the foreign exchange risk management, that is hedging strategies. If the question they ask what are the hedging strategies used in the foreign exchange market, then you are going to tell first one is forward market, future market, options, and swap. Remember this thing. Then understanding the foreign exchange risk. So as I said, if the currency appreciate or depreciate, let me take a previous example. If you are bringing the phones from USA, then we need to pay the amount. If there is a fluctuation, currency fluctuation, if it is appreciate or depreciate, then definitely there is a loss for one country. So minimize that risk, we are using certain hedging strategies, and we are going to manage the risk of loss. It will happen in import or export also. If somebody is importing, somebody is exporting, if suddenly due to some reasons or due to some conditions there is a variation in the currency or fluctuation in the currency, obviously it is a risk or a loss. So there are main three types of foreign exchange exposure. Exposure is nothing but risk. The one more name of exposure is risk, foreign exchange risk or foreign exchange exposure. The first one is transaction exposure. So transaction exposure, as the name itself indicates, transaction is nothing but dealing with or exchanging with other countries, or cross-border transaction, importing or exporting the goods and services. You can take the same example or you can use a different example. Take for example, we need to borrow 100 tons of rice from some other countries, then we are importing, they are exporting, suddenly the Indian rupee will decrease, the value of Indian rupee will decrease. What will happen? The other country will face profit, because our country currency value is decreasing. It is a benefit for the other country, it is a loss for our country. So during the time of export or import or this kind of cross-border transaction, if the currency fluctuates, that fluctuation risk is nothing but transaction exposure. You can see in the example also. I will forward this PPT to the group. The same example is given in here. Transaction exposure is nothing but while importing or exporting or while doing the cross-border transaction, if there is a variation or fluctuation in the currencies, then that fluctuation risk is nothing but the transaction risk. Next, translation risk. What is translation? The best example I can give you is, take for example, India is having an MNC company. Take for example, XYZ company is there. That is an Indian company and it has a subsidiary in USA. Indian company, the home country is India, the subsidiary company is USA. Whatever the transaction we do in US market or US location, that is entered in the local currency. Can you able to understand? In USA there is a subsidiary company. Whatever the transaction US country makes regarding this company, that is entered in financial accounts for financial statements. Take for example, balance sheet and profit and loss account. Whatever the transaction makes by US subsidiary, it will enter in the form of US dollars. Later on, at the end of the year, those financial statements under US subsidiary is converted into Indian rupee. Because India is a home country, it should submit, that subsidiary company should submit balance sheet and P&L account in the form of Indian rupee while they are translating. If there is a fluctuation in the US currency regarding the transaction, if there is a fluctuation, then obviously while they are translating US financial accounts to Indian rupee account, then that loss, that risk is called as translation exposure. You can see here, when a multinational company operates in different countries, it conducts business and operates revenues, incurs expenses, holds assets and liabilities in various currencies. If it is 100, take for example 100 subsidiaries are there, 100 subsidiary country will have 100 different kind of accounts in the name of their own currency, but later on they need to translate that into the Indian financial statements using Indian rupee. That risk, the translation risk, is nothing but translation exposure. You can see here in the example. Next one is economic exposure. Economic exposure is nothing but economic risk. This arises due to the geopolitical factors or due to the macroeconomic conditions. What are the macroeconomic conditions? The fluctuation happens because of economic policies, take for example fiscal policies, monetary policies, and due to tax regulations, or due to the political background, or geopolitical instability, or the government regulations. Whatever the changes happens because of economic factors, then that risk, that fluctuation due to economic is called as economic exposure. Obviously it will happen. Take for example, if you are making the transaction, suddenly the government will put some restrictions on some commodity, or it will increase the tax rate, then obviously that will reflect in the price of the product. Then obviously that increase in the price of goods will affect our company. That risk is nothing but economic exposure. Whatever the changes or fluctuation happening in terms of economy, that risk is nothing but economic exposure. So we studied about what is foreign exchange risk, what is foreign exchange risk management, what are the hedging strategies we are going to use, that is future, option, swap, and forward contract. These are the hedging strategies. Then we studied which are the three types of foreign exchange exposure, that is nothing but risk, foreign exchange risk. We studied three types. One is transaction, translation, one more is economic exposure. And next concept is swap. Swap is nothing but exchange one with another, that is a swap. So swap is an agreement, it is a derivative contract between two parties for financial exchange, so that they can exchange the cash flows with one country to another country through a swap. Like it's nothing but one counterparty or one company will promise us to exchange another country currencies or the interest rate. There are two companies, A and B company are there. A company is having a loan of 10 lakh rupees and it's paying floating rate. Take for example 5% floating rate. A company is having a loan of rupees 10 lakh with 5% floating rate is there. There is a B company with same 10 lakh loan and it's paying the fixed interest rate of 7%. There are two companies, A and B companies, both are having the loan of 10 lakh, but A company is having the floating rate of 5% and B company is having the fixed rate of 7%. And both are going to expect that one interest rate will rise, one interest rate will fall. At that time what they will do, they will come to an swap agreement between two companies and they will exchange the interest rate. One is having floating rate, it will exchange with fixed rate. That is nothing but swap. Because of that they will get an advantage. The swap is having two different types. It is having four different types, but mainly we use two things. One is currency swap, one more is interest rate swap. Currency swap, as the name itself indicates, currency swap, here the principal amount is exchanged. I gave an example of two company A and B. They are having the 10 lakh loan, 10 lakh rupees loan. What they will do, they will come to a financial agreement between two parties and they are going to exchange currency and interest rate with another currency. One country is exchanging principal amount plus interest of another country. Both are exchanging. Coming to interest rate swap. Interest rate swap is nothing but here they are going to exchange only the interest rate, not any other things, not the principal amount, only the interest rate. That example only, fixed was exchanged for floating rate. Currency swap is nothing but they are going to exchange principal amount plus interest rate between two currencies, and in interest rate swap they are going to exchange only the interest rates, fixed with floating. So in the next class we will start with the swap problems regarding the interest rate swap. Thank you.